Well, good afternoon, everyone. I think we will go ahead and get started. We have a lot of demand for this call today, which is great as we're letting additional people join us. So welcome. We're very pleased to host our Midland Wealth Management Mid-Year Outlook today. And it's particularly my pleasure to host. I am Jayne Hladio, President for Midland Wealth Management, recently joining the organization in June of this year. And I would like to share with all of you that joining this organization has been the greatest decision of my career. We really do have the best of both worlds at Midland Wealth Management and Midland States Bank. It's that hyper-personalized attention and great empathy and compassion with our service experiences. But it's combined, as you'll see today, with world-class expertise, products, solutions, and services that we have to offer with all of you. So today, I know all of our curiosity is piqued, certainly with the Fed rate increase today. And I would like to ensure that all of you are very informed with the insights that we provide. We do have three distinctive competencies at Midland Wealth Management that I do want to emphasize as I introduce our amazing leaders today that will be facilitating the call. We have over 100 years of expertise in navigating through uncertainty at Midland. And this is not something that everyone may be aware of. So this great strength of particular compassion in navigating through these times with our clients truly is our distinctive competency. Number two, as I mentioned, the depth of expertise and the way that we can work so closely with our clients is excellent. It's particularly noted at a time like this because our client counts are not so incredibly large or impersonal as can sometimes be the case in a very, very large organization. So we really like that proximate relationship we have with our clients. And then three, everything we do in terms of trying to anticipate market trends, if only we had a crystal ball, we really see our fiduciary responsibility as going even beyond being excellent investment managers. We do take a lot of pride and time in doing financial planning with our clients and thinking through helping them navigate many sets of decisions that can impact your future goal attainment in your life. So thank you for that opportunity to serve you in those ways. I do today want to go ahead and introduce our amazing leaders that have joined us to facilitate today. And obviously, Betsy Pierson, who is our Chief Financial Investment Officer, and Tracey, Garst, Senior Portfolio Manager, have been providing to many of you incredible knowledge through the years. This is just one more forum today where they get to do so. One of the distinctive competencies that these two really possess is meeting with all of our investment advisory teams and really thinking through the entire investment process and strategy for the entire group and for all of you. And I particularly like the fact that Betsy and Tracey take great pride in establishing close relationships with our clients, our corporations, our foundations, our financial institutions, and trust, and communicate extremely well what kind of financial planning and investment strategies we will be employing next. So without further ado, I'm going to turn it over to Betsy and just remind all of you that we will open up the chat capability so that as you have questions today, feel free to enter that and we will entertain those as we conduct the call. So Betsy, I'll turn it over to you.
Hey, thanks, Jayne. I really want to start with kind of a summary of where we've been. So as we all know, the first 6 months of this year were definitely a challenge for every investor. The only place really to hide was in cash, earning zero for most of the quarter, most of the first 6 months, or I guess oil. That would probably be the other option, just as we know how oil prices went up in some commodities. As you can see on this chart, even bonds were extremely negative. We had the worst investment grade bond return in recent history. And even if you look at the 10-year Treasury, we had the worst return on the 10-year Treasury since 1788. Hard to believe, but when you go back to the history books, and Tracey and I both were sitting here thinking, have we been in the market that long? But almost. But it was really a challenge for investors. And the same when you look at the equity side of the investment equation. Everything's down double digits throughout the year. The second quarter was actually worse than the first quarter. It was really not a good time to be investing. But what do we think is going to happen? You know, what drove the markets in those first 6 months? Really, it was inflation, interest rates, and repricing of equity valuations. So what's going to impact the markets the next 6 months? And this is what Tracey and I are going to dig into. And the first thing we're going to cover, really, I'm going to cover is inflation. So what led to the higher inflation? So if you look at this chart, this is the yearly growth of M2 money supply, which is the liquid investment sitting out there, available cash, money sitting on deposits in banks, anything that's really liquid. It had a dramatic growth spike during the pandemic. Now, what caused that? Well, we all know there was a lot of stimulus put forth to the consumer. There was help to the businesses. We had the extra unemployment, a number of things that made most people somewhat cash flush, because when we were shut down for that time frame, there was no place really to spend it. So it all sat there and they just kept getting it. And whether we needed to do just the one stimulus or we needed to do three, we could debate over the moon on. But what it really did is that it put so much money out there starting to chase too few goods and services. And with that, then you get a typical spike in inflation. It happened back in the 70s. What is more interesting, and we want to look forward on inflation, is you see this dramatic decline as well over the last 6 months in the growth of money supply, which is probably better for the economy longer term. Will inflation follow? Has it peaked? Will it make that kind of decline again? Those are the things that we're really monitoring here, because that will lead to a lot of the outlook of what's going to happen over the next 6 to 12 months. So the question is, has it peaked? When you look at this chart, there's really the top three right here are considered somewhat transitory, which means that they can move up and down very quickly. So energy would be one. We had a huge spike in the second, first and second quarter in energy costs, primarily due to the Ukraine issue, increased demand in many places. It got out of whack. And as you know, it's come down from those highs. The next is the new and used vehicles. As supplies have started to come back on the lots in both used and new vehicles, the pricing pressure that we're going to see from that is going to subside. So it's more transitory. It's more that supply chain issue. And then food at home. And that really comes down to somewhat of a commodity thing, because as people buy their food at the grocery store, those prices have gone up pretty dramatically, but a lot of it's been the input costs, the shortage of grains, the shortage of everything, the shortage, the logistics issues, getting things to the store, all those things. And that may subside. And what I mean by subside is it doesn't mean the price of the food is going to go down, but the rate of change that goes into calculating the inflation rate will be less. So it's more transitory. Things that might not be as transitory, we may still see added pressure in, is shelter is a main one. So when you look at the CPI, it's the shelter part is composed of what they call owner's equivalent rent. So it's not the housing prices. And we all know housing prices have gone up pretty dramatically year over year the last 2 years. And they'll probably fall in this market, just at least the rate of change will fall. And may even, people may start cutting housing prices because we are starting to see more supply. But it also takes into account the rental cost. And rental costs, landlords were not necessarily able to raise rent or even kick renters out for 2 years during the pandemic. And now they're raising those pretty phenomenally. And as well as we have a shortage across the country of rental places. We need more multifamily housing. And that is being built, but it doesn't happen overnight. So there's going to be some continued pressure there, and it may continue to increase. Restaurants and services, hotels, transportation, that may show some things. So there's some sticky things, there's some transitory things. And this would lead us to believe that at some point, inflation will fall from the high levels. So maybe we hit the peak in June, but are we sure? We don't know. We'll continue to monitor that. But one of the main things that goes into that is the commodities. So when you look at this chart on the commodity index, we were really stable through 2021, a little uptick. We really saw the big pickup really as Russia started invading Ukraine and people started going out and spending money. So we saw a huge increase in the commodities, up and hit a peak in April. Energy hit its peak in kind of early June. And since then, they've subsided very, very quickly to lower levels, which is more what you might call even almost a deflationary impact. But will inflation follow? When you get into the individual commodities, when you look at many of these, you look at lumber. Lumber's down 57% from its 52-week high. Aluminum and copper. Copper's down 24%. Palladium's down 37%. Aluminum's down 37%. The base metals are all down. All the things that go into building products and batteries and all those things. Energy, crude oil is down. It's down probably 20% from its high now since this chart was published. Natural gas has actually increased again with the Russian issues of supplying natural gas to Europe and cutting it down to a 20% supply. That may be an ongoing issue because we'll probably, as a U.S., will probably need to export more natural gas to those economies, which may put pressure on our prices. But in general, commodities hit a peak and they've all fallen pretty dramatically off of that. But will pricing follow? That is the question as we go into this. One of the reasons, and we were looking at it from an inflationary standpoint, we think that it'll probably fall back to that 4 to 5% level by the end of the year. Now, will that happen? It's to be seen yet, but when you look at all the things that have taken into account, the commodities declining, housing supply has started picking up, those prices are going to be declining, or at least not rising as quickly. Those kind of things. Inflation will be less at the end of the year on an annualized basis than it is as of June. So we're going to continue to monitor that, but we do think that will take hold. Looking at interest rates, which was another part of it, this is the yield curve. By the yield curve, I mean it's the interest rate on the Treasury securities from 3 months to 30 years, all at the different levels. When you look at what happened to the bond market and the total return for the first 6 months, this will explain a lot of it. So the green line here is where we were at the end of December on interest rates. So for example, the 2-year was at about 0.75%. Today it is over 3%. The 10-year was at 1.5%. It's now around 2.80, but it had gotten as high as 3.5% in mid-June. So we've seen some dramatic increases in interest rates in anticipation of the Federal Reserve making moves to raise interest rates to fight inflation. And that is exactly what happened. And when you look at the total return on a bond, you have to look at the income that's received from the bond as well as the difference in, the price change to, so basically when rates rise, prices fall. An interesting thing that happened in this market is that we weren't really earning any interest. There was no coupon payments coming in, no cash flow coming in. So our total return ended up being the change in the price of the bond. And even when you go back to the 70s and 80s, when we've had higher movements up in interest rates of this size, we've always had income to offset that. The bonds may have started at a 3 or 4% level. We started at close to zero. There was nothing to offset those prices, and so it became very painful. We would argue at this point, though, that while the Federal Reserve may still be making moves, the worst of the bond market performance is behind us. Now we have income. If the interest rates go up slightly more, we have income to offset those price changes. We should not see a negative 10% return in the second half of the year, and it may even be flat to positive. We'll probably still be negative for the year. That's going to be a hard one to offset, but we should see some benefit. And with that, we have actually have extended our maturity in our portfolios, knowing that we've had this move. We were about 20% short our benchmarks going into this year. And with this rate move, we moved to about 10% short, and most recently we've gotten closer to almost a neutral level on our maturities, because we do believe that the worst is behind us, and there's some value in being in bonds today more than there was 6 months ago. The big thing that's going to be laying out there is what the Federal Reserve is doing. As we all know, the Federal Reserve is raising rates to fight inflation. Their mandate is full employment and a 2% inflation level on average. We have full employment. They aren't worried about that at this point. We're probably more than fully employed. They are truly trying to fight inflation. Now, is 2% the right level? We could debate that. On a historical basis, inflation's been about 3%, but we've gotten used to having the globalization and the lower inflation rates over the last 20 or 30 years. That may be subsiding a little bit as we become maybe less global. We'll still have globalization, but I think there's more political issues out there that will limit some of that globalization benefit, namely Russia and China being maybe more self-caring and not as open to it, and we have to be more cautious about our trade partners. But the allies and the trade partners that we do trust will continue to use to keep costs in line. But with that, the Federal Reserve is raising rates. Today they're meeting, and in about 45 minutes, they'll announce that they almost 100% sure that they're going to increase rates by 0.75% on the short-term overnight rate, which is 75 basis points. So right now that stands at about 1.5%. That will be at about 2.25% as of the end of the day today. It's built into the market. This chart really is showing what the Federal Reserve, what the market thinks the Federal Reserve is going to be doing over the next 24 months, almost out to January 24. So about a year and a half. So what basically we're here today is where we're going to end up, close to that 2.25 to 2.5. It's built in. The market is anticipating that the Fed will do another 75 basis points, 0.75%, in September, and then possibly another 0.5 to 0.75 before the end of the year. The market is anticipating that we're going to, at that point, either have lower inflation or we will be in a recession, and then the Fed will have to start lowering rates. Now, that's the conundrum that we're in, and it will be interesting today to listen to Powell's comments about what they think is happening. I do believe that they're not going to say they're going to take their foot off the pedal, that they're going to still fight inflation. It's going to be based on data that comes in. They have their meeting today. They don't have another meeting until September, so they will have 2 more CPI numbers to look at to see if anything's changed and what they need to do, as well as they'll be able to monitor what's going on in the economy from a supply-demand issue and the growth level. So while it's an unknown, the markets are anticipating that the Fed is probably going to throw us into a recession. That's what the bond market at least is looking at. Now, the equity markets, we'll get into that one in a few minutes, but the bond market is thinking the Fed is going to put the clamp down to fight inflation. Historically, they have not been able to do that effectively. Going back to one of the previous charts, this one, another thing that the bond market is looking at typically is the flat to inverted curve. We had a fairly steep curve here back in August, about a year ago, where there was a fairly large difference between the 3-month and the 30-year, almost 2%. Today you look at it, and what you really have is everything 6 months and out is higher than the 10-year. That's what we call an inverted curve. And historically, people think when we get an inverted curve, it leads to a recession. You can't quantify it 100%, but it has a fairly strong correlation. But it's really when the 3-month gets higher than the 10-year is when you really know it, because then the Fed has really clamped down. The 3-month is much more determined on what level it's at by what the Federal Reserve is doing with short-term rates. And at this point, that's at 2.5. It's building in the rate increase today. It'll probably go up to 3. We will be inverted by the end of the year. And the question will be, will that throw us into a recession in 2023? Things to think about. Many people have already been talking about we're in a recession, because when you think about the technical indicators, on a technical basis, 2 negative quarters of GDP is classified as a recession. The first quarter of GDP in the US was a negative 1.6%. In this chart, it basically breaks down what you can see is that the consumer was still strong. Business investment was still strong. What hurt us was our extremely high level of imports relative to exports. Part of that's due to weaker global economies, strong dollar, and that we were basically strong and have huge demand. So it wasn't that we were shutting down or negative because our economy had slowed. It was really because we had more demand for products than our trading partners who we export to. So while it's a negative number, it's not reliant on what a real negative recession is. The next number comes out Thursday morning, and the numbers anticipated by several people who get surveyed is that it will be about 0.4%, 0.4% growth for the second quarter. I know the Atlanta Fed GDP, people follow that. That still is targeting a negative number, but I think some of the more recent numbers that came out today, we had some, our net trade balance and those kind of things. It looks like the exports and imports are more equal this quarter. That should help. The consumer is still spending before inflation, whether it's on goods or services, that's to be determined yet, or on gas and food, but they're still spending. We'll probably have a positive GDP, so that conversation about the two negative quarters may go away. If you look at another definition of recession, it's the National Bureau of Economic Research. They're the ones who actually declare that we've been in a recession, and it's usually lagging. They usually don't declare it until we're almost out of it, because they look at several different things. They look at significant decline in economic activity across the economy that lasts for more than a few months. While we had one of those recessions in 2020, we could argue that it wasn't a quote unquote real recession because it wasn't caused by the normal factors. It was caused by an exogenous event that caused governments to shut down economies while there was still demand, but we couldn't produce, we couldn't buy, we couldn't do a lot of things. But we haven't had, quote unquote, a real recession since 2009 when we came out of the great financial crisis. So it's been a long time since we've had a typical business cycle recession. Will we have one? We would odds on that, there's a 50% probability that in 2023 we have a recession. The question is how severe it is. But if you look at where we are today, we are nowhere near recessionary with the thing. The only thing that might be is manufacturing. Parts of manufacturing have rolled over. We have seen some what we call our ISM, the manufacturing surveys. When they're under 50, it means that growth has slowed and it's actually deteriorated. We've seen some of those regional numbers drop below 50. We've seen it happen across the globe. I think Germany's below 50. That's probably the one area of the market that's showing though some breakthrough. Employment still remains strong, but employment is pretty much a lagging indicator. Companies don't typically cut roles until they have to. And especially in this environment, we may see less job openings. We're already hearing that from some of the technology companies that they're taking some of their help wanted away. They're cutting some parts of their businesses and laying off people. That's a typical early sign that we would monitor, but it's not happening everywhere. People are, on the lower end, they've gotten fairly strong job, wage increases. While it barely keeps up with inflation and in many cases isn't, it's still more money than they were making before. And people are still consuming, maybe at a lesser rate than they did 2 years or a year ago because we had so much pent up demand, but it's still at fairly high levels. But the risks of recession have really increased. So this chart shows month by month the different indicators that you would look at. So the consumer, business activity, and financial. Housing permits have continued to be higher, but what we've seen in the housing permits, it's the multifamily more than single family, which would mean that the single family home market may be declining. The numbers yesterday came out on new homes. The sales declined. The supply of inventory has increased in 9 months, which is the highest it's been since 2010. So some people are pulling back with the higher interest rates, with the affordability issue, a number of things. And these are the things that the Fed is trying to get under control because things got out of whack. Not that we were in a housing crisis or with leverage like we were in 2007, 2008, but the affordability level had definitely become less affordable, and housing prices were up 20% year over year. I think the last 2 years, you can't maintain that. You have to bring some of that back in. Job sentiment, while it's still strong, it has rolled over a little bit, but still strong. People still feel comfortable in their jobs. Jobless claims remain low, which means there's very low levels of unemployment or people being laid off. Retail sales are a question mark. They've probably slowed somewhat, and I think everyone could listen to Target and Walmart talk about how they have the wrong inventory. Consumers aren't spending money on that. I think retail sales in general are declining a little bit because the cost of gas and food has gone up and is taking away from some of that discretionary spending. And wage growth, it's slowed down a little bit this year. It's not keeping up with inflation, so you could look at that and say that's maybe some issues. Commodities are cautioning because they have hit a peak, and they are starting to roll over. The ISM new orders, which is a manufacturing, that actually is starting to slow. The supply chain is starting to catch up, so there's some slowing there. Profit margins have continued to be strong, even though I think in this most recent earnings cycle that Tracey will get into, there may be a little bit more concern about the margins. They may be a little bit less than they were, but that's also the cost of doing business. We had some very strong profit margins going into this, but that could change. Truck shipments continue to be strong. UPS had great earnings. Their number of deliveries was down. They were able to have pass through costs with pricing. The one thing that we are watching closely is credit spreads. They have come in a little bit. So credit spreads are basically the difference between what corporations pay and what the Treasury pays for similar maturities. They got extremely narrow as people took on more risk. People were chasing yield. Now they are back to the more normal level. But if we do see that continue to widen out, that is a precursor to potential recessionary issues. It means that credit demand is fallen. It also means credit standards are getting tighter. People have to pay more to borrow, those kind of things. So we're continuing to monitor that, but that has definitely been a negative in the last 3 months in the markets. Money supply, we talked about that before, and the yield curve. Well, it says it's still expansionary here. I think it's gone more inverted in the last month as the 10-year has rallied from 3.5 to 280. And the rest of the curve has not moved. So I think that's probably more caution now in July when you see this come out than it was in June. So we do think that the recession risks have increased, albeit we don't think there'll be a recession in 2022, but the risks in 2023, it really will depend on what happens with inflation and the Federal Reserve and how aggressive they become. One of the other things we're monitoring is the consumer sentiment. It's really declined. People are fearful of inflation, and whether it's because they're reading headlines or if it's reality, you don't know in today's environment because there's so much news out there, things that people never would have paid attention to 30 years ago. They have immediate information on, and I think it impacts our sentiment. I think social media impacts our sentiment because we talk to your friends, you talk to other things, you read it on the note and the internet, all those different things. But sentiment definitely has become more negative. The bottom chart here basically is the U.S. current activity that Goldman Sachs follows. And while it's gone negative, barely, it's something we're going to continue to watch because this indicator is rarely negative outside of a recession. And it just dipped below zero in the last month. But things that, we talked about, single family home starts have slowed due to higher mortgage rates and affordability. Retail sales, ex auto and gas, have declined. The consumer can afford less. Manufacturing starting to decline with the several regional ISMs now at below 50, especially the new orders. And real average hourly earnings are negative, and that's inflationary. So if we can get inflation under control, that will help. But it takes away from our current activity. And these are the things that we will continue to monitor. We think we'll continue to have growth in the second half of the year, albeit for the year will probably be somewhere between 1% to 2% GDP growth, which is a more normal growth rate for the U.S. But we are going to be monitoring closely of where the Fed is going to be going, how far they're going to go, and will they go too far and throw us into that recession by tightening too much. And then if they do throw us into a recession, as we go into and if we do go into a recession, the consumer and corporations have both been in pretty good financial shape. They have pretty strong balance sheets, much better than the last time we went into a business recession like this in 2007. That was all caused by leverage. It was very deep, very painful. We would compare it more to like if you go back to 90 to 91, maybe even parts of 2000, where 2000 probably would have been more shallow had we not had 9/11 in the middle of it, those kind of things. So we don't see it as being long-lasting and extremely severe if we do have a recession, but we do need to keep aware of it, that it does impact people on a long-term basis. The bond market's already kind of building in that we might have one. Credit spreads may continue to widen on that. We have increased our treasury exposure in anticipation of a potential recession, just because we were very underweight treasuries in most of our portfolios, and we just felt it was better to get closer to a neutral weight, and we have done that over the last couple months. So from that standpoint, in economic, we're really monitoring it, but we do not see a recession in the next 6 months. Tracey?
All right, thanks, Betsy. I think the first thing I'll start with is Betsy and I have both been around for quite a while, 35 plus years. I don't want to date either one of us, but it's interesting. This first 6-month period for stocks to start the year is the worst 6-month period since 1970. And so that goes back quite a ways. We've been through a number of bear markets, recessions, and so forth. So for us to have to actually go back to the history books kind of says something. The talk about recession, there's so much discussion about a recession going on. It can be a self-fulfilling prophecy, whereby we actually talk ourselves into a recession. At this point, as Betsy said, I'm not going to go into a lot of detail. Sherry covered it very thoroughly. A lot of things are not pointing to a recession at this point, but it doesn't mean that we can't fall into recession. And to a certain extent, we think, you got to remember, stock markets are always forward-looking. So the markets are already looking forward into the possibility of recession. And, we believe that's why we have seen a pretty significant repricing of the equity markets this year. I think we have to realize, as Betsy indicated with money supply, we're working off a lot of the excesses from an extremely dovish Federal Reserve and Congress, and a lot of liquidity that's moved into the market. It's something that has to be done periodically. And although bear markets are not pleasant, none of us like it, they do serve a purpose into working off some of these excesses. We can talk about some of the stay-at-home stocks that really had no earnings. They had little revenue growth, but yet were trading at ridiculous valuations. You can talk about some of the cryptocurrencies that we're seeing that are beginning, several that are filing bankruptcy. So these are the excesses you see. We saw some of the technology bubble in 99 and 2000. And these type of excesses need to be worked off. And it's healthy for the market to do that. As I said, it's certainly not pleasant, but it is needed from time to time. And we truly have not seen a recessionary market since 2008 and 9, except for the pandemic. So what we have seen is a significant repricing. If you look at PE multiples on this chart, the S&P 500 PEs really have come back to their 25-year average of about 16 times earnings, much cheaper than what we have seen over the last several years. For the most part, we would look at stocks as pretty fairly valued today at these levels. Of course, the big question that we're faced with and going forward is when we look at PE ratios, price divided by the earnings, what is the true E? What is the actual earnings in this environment? Companies are faced with a slowing economy. We're faced with higher inflation. And U.S. corporations, many larger corporations, are struggling with the stronger dollar. That stronger dollar is having a significant impact on their profit margins. So we have definitely seen earnings estimates begin to move lower. And I think that's something we have to watch pretty consistently. We had some pretty big earnings reports from Microsoft and Alphabet, Google last night. Overall, they're pretty good numbers, but profit margins have come down a little bit. And I think that's to be expected in this environment. As I flip to the next page, I think something is very important to realize when we throw around, what is the current PE ratio of the S&P 500? I think there's little argument that the current PE is about 16 times earnings. However, if you look at the left-hand chart here, the top 10 stocks by market cap in the S&P 500, those are basically your Apple, Microsoft, Amazon, Google, Berkshire Hathaway, Johnson & Johnson, NVIDIA. Those stocks currently carry about a 23P multiple, significantly higher than the 16 times of the S&P 500. However, if we exclude those 10 stocks, the other 490 plus stocks of the S&P 500 currently trade at about a 14P ratio. So much more attractively valued than even the actual 16 times that is being quoted on the S&P 500. We think that's very important to realize that many stocks are down 40, 50, 60% from their highs and are very attractively valued. Another thing that's very important in the S&P 500 is the chart on the top chart on the right, the concentration of these stocks. These 10 top holdings have made up almost 32% of the S&P 500 index. That is now down to under 28%. It's still higher than what we would want to see. And this has really led to a very difficult situation for particularly large cap mutual fund managers to outperform. Many of them are not going to own 7% or 8 or 10% of Apple, which is what you would have to own to outperform the index. Not going to hold greater than 6% of Microsoft. So very concentrated portfolio, concentrated S&P 500. It is beginning to slide back down. And part of that is maybe because some of the other stocks in the index are beginning to improve. The last chart at the bottom right, I think, is very important. This is the earnings contribution to the S&P 500. Those 10 stocks contributed nearly 34% of all earnings to the S&P. And that is now down to 21, 22%. We believe that will continue to go lower as many of these other areas within the S&P 500 begin to perform better as we see improvement over the next couple of years. So these are actually good signs for the S&P 500 index as a whole. And the valuations maybe are not as extreme as the 16 times that is quoted right now in the index. Earnings are definitely our primary concern right now. As I mentioned, the E in PE is very important, and our feeling has been that analyst estimates have been too high, and we have kind of expected earnings estimates begin to drift lower, particularly as the economy slows down. And you can see the S&P 500 earnings right now, earnings growth of about 6.4%. But interestingly, if you exclude the energy stocks, which have done phenomenal with cash flow and earnings, we're looking at about a 3% earnings growth for the S&P 500. So we are seeing earnings growth begin to be ratcheted down. Longer term, this is actually good. And the reason we say that is that analyst expectations have just been too high. Once you reset the bar lower, down the road here in the next 6 months, 9 months, year, 18 months, companies will gradually be able to exceed those earnings estimates. And that's what we want coming out of a slowdown, is for companies to begin to beat earnings estimates on the upside. So over time, this is actually a good thing and something we've been waiting for. And on the right-hand chart, you can see earnings estimates for the S&P 500 historically have been very closely correlated to the ISM manufacturing PMI index. And Betsy said manufacturing has slowed down. And historically, you can see from this chart, the blue line that's falling, that's the ISM manufacturing index. The S&P 500 earnings growth tends to follow. and there is a lag to it. So we are seeing a lag, and those earnings estimates are beginning to come down over the last 2 quarters here, and we would expect that to continue as we move through this slowing economy, and with possible additional earnings revisions to the downside. Again, as a result of a slowing economy, higher inflation eating away at profit margins, and also something that's very we need to take into consideration that's coming to play is the strength of the dollar. The S&P 500, if you look at the stocks that make up that index, over 40% of those revenues and earnings come from overseas. So in our view, if you own the S&P 500, you automatically have international exposure. But if you look at this chart on the dollar, we are at the highest level the dollar is since 2002, coming off of the technology bubble and the great technology pullback. That is pretty significant. And the point to be made here is, are we beginning to see the dollar peak in strength? And I kind of put that in a lower chart, which is a relative strength chart. If you look at that red line where it's kind of hit some of its peaks, there might still be some upside in the strength of the dollar, but we are definitely at a point where likely down the road, we will expect the dollar to weaken as we move forward, which will help some of the earnings estimates for these large U.S. corporations. Microsoft reported last night, and roughly 3 to 4% of their earnings growth and revenues were impacted by the stronger dollar. It's been pretty consistent, anywhere from 2 to 5% impact from a stronger dollar on these large cap U.S. corporations that have international exposure. So one good thing about the dollar is a strong dollar. It does create deflation. So at some point, we believe this will actually help push inflation lower. It will help the Fed with what they're trying to accomplish. And it will help corporate earnings as the dollar begins to pull lower. Not sure when that'll happen, but possibly we are nearing some peaks, maybe over the next 6 months. If we look at valuation, we talk about the U.S. market at 16 times earnings, maybe 14 times if you exclude those top 10 stocks. International markets are definitely cheaper. You look at European valuations right now, trading at roughly 12 times earnings compared to 16 for the S&P 500. We have felt that was attractive earlier in the year. We actually had an overweighted position to international stocks because of the huge discrepancy in valuations when the U.S. was trading at a 20p multiple. Even though Europe is trading cheaper, the U.S., some of this frothiness, we'll say, has been worked off of the U.S. market. We're finding the U.S. market more attractively valued today. And we have actually, one of the changes we have made recently within the last week or so, we're actually reducing our international exposure, primarily our developed international exposure, which would be heavily weighted to Europe. Looking at the situation in Europe, much of it is the fallout from the Russia-Ukraine war. The energy crisis that Europe is faced with is not going to go away anytime soon. We think they could have a recession and likely they are going to have a recession and a more severe recession than the U.S. So we've elected to reduce that exposure there as this uncertainty unfolds as to how they're going to get through a difficult energy environment in the winter months that we're going to have at the end of this year. So that is a move we made. Emerging markets, we're going to hold our steady on our allocation to it. It's very cheap. Two things: if the dollar weakens, that's going to help emerging markets. And the other thing we think is a wild card is China. China has an election in November. The president is trying to get his third election, and they need a stronger economy. So we think we could very well see some significant stimulus in China, which is a large part of emerging markets. So that's something that could actually be a tailwind for emerging markets moving forward. But we definitely did reduce that international exposure. Something as we go through this bear market that we've had in the past, we've had bear markets. I think something that's important is looking at U.S. corporate balance sheets. And this is nothing like 2008 and 2009, and really nothing like 2020 pandemic. Corporations are in very, very strong position right now. The top chart actually just shows their corporate debt level compared to cash flow. Very, very strong levels that we're seeing right now from U.S. corporations. The other thing we talk about is their interest coverage ratio. Corporations have a really record cash flow in order to cover all of their debt payments to bondholders. So again, very, very strong position for corporations. And also, I think with that position, you could say that it also allows large corporations to buy back their stock and share buybacks. So at these low levels, we would expect companies to continue buying their stock back at pretty aggressive levels.
Your chart.
What's that? What happened here?
This happens sometimes.
We're having a little problem here. We'll get technical.
Technical difficulty here.
We'll get it figured out.
Got a couple of outlook charts left, and I'm not sure why these are not showing up.
We'll get it up.
We're working on it right now. So I'll talk through one of the charts we're pulling up is a chart. There it is. Go back one. There we go. Okay.
I got to get it on Teams yet. So
oh, okay. Regards to outlook going forward, and a lot of talk about whether the stock market has bottomed yet or not. I don't think anybody really knows the answer to that. Much of that is going to, frankly, depend on the quarterly earnings we're going through right now. I think last night was good with Google and Alphabet. We got almost 25% of earnings coming out this week. The other thing is going to be the Federal Reserve, how aggressive the Fed gets over the course of the next 6 months. And one of the things we look at is the drawdowns that the bear market correction drawdowns we have seen so far this year. And we've had about a 23% correction within the stock market. This has put us in a level that is very similar to bear market corrections. 20 to 25% is very typical of a bear market correction. Very typical what we saw in 2018, what we saw in 2016 and 2012. So we can argue that the market has been pretty similar to typical bear markets and significantly oversold. I think that's why we're seeing a rally here in July as we progress through these earnings reports. So we're actually looking at probably a rally going into July and August. The question then is going to be what happens as we move into the midterm elections. At this point, the consumer sentiment is extremely low. When we get, pardon, are they able to see this or not?
Yeah.
Oh, all right. So now that I can see the chart, this consumer sentiment chart, historically, consumer sentiment is a contrarian indicator. Warren Buffett always says, you want to be selling stocks when everybody is optimistic and bullish. You want to be buying stocks when everybody is fearful. This is the Consumer Sentiment Index, and if you look at the current reading at 50.2, I believe it's 51 right now. This is the lowest level we've seen since 1980. And the number that underneath each of these readings on the downside is the S&P 500 stock market return 12 months after the bottom in consumer sentiment. So the market is setting up potentially for a very strong rally since we are seeing such extreme pessimism in this market. This is not unusual. This has happened numerous times when we get to these extremely low consumer confidence levels, which are also oversold situations. Historically, when consumer confidence is at a high level, you've had very subdued returns in stock market returns, equity returns over the next 12 months. So this actually sets up favorably for the stock market over this next, we'll say the next 12-month to 18-month period. So that's what we would put in as a positive indicator. Another very interesting situation is midterm election years. And this chart goes back to 1962, and every midterm election has seen a negative drawdown in the S&P 500 the year of the midterm election. And the average of these drawdowns has been about a negative 19%, which is similar to what we're seeing in this first 6-month period. Again, a very interesting scenario is the blue bar chart on top. That is the recovery from the sell-off on these drawdowns 12 months after the market lows. And the average return has been about 30% on the upside once the market has put in a bottom. And the hard part is, when does the market put in a bottom? Nobody really knows that answer. We believe we're closer to the bottom, of course, than the top. And at this point, we think that there's a lot of upside reward potentially built into this market with the downturn we've seen. And the last chart I would put in, I find it very interesting. When you get in environments like this, you have to go back and look at what has history shown us. And, although history may not repeat itself, we do believe it rhymes. And if you look at the year we're having in 2022, this is actually setting up very similar to the stock market in 1962. In 1962, we had JFK was in his second term, the second year of his first term. A single party controlled the White House and Congress, as it does today. The Fed was raising interest rates because the economy was strong beginning the year, and the economy began to weaken by the Fed raising interest rates. The risk of recession increased dramatically. We had a major geopolitical issue with the Cuban Missile Crisis. That situation also led to supply chain problems with oil and grain and other resources. So if you look at the chart, really in March, it really did not look like we were really going to follow the same trend. But in May and June now, this thing has really been following very, very similar to what we saw in 1962. If it follows trend, we would expect a rally like we're getting right now, July, August, late August, maybe even into early September. Then maybe we get a pullback as we head into midterm elections. We start looking at third quarter earnings reports coming out. Could we get a retest of the low? It's very possible. We didn't in 62, we didn't get a perfect retest, but we got a very close retest of that low. Then we had a very strong rally at the end of the year. So we think it's important to keep an eye on these type of long-term trends. Although they don't repeat themselves perfectly, we do think there is some similarity to it. So possibly more volatility throughout the summer, early fall, but expecting maybe a significant recovery the fourth quarter. And some of that will very likely coincide with what the Federal Reserve does throughout the rest of this year if they turn from a more hawkish view to a more dovish view. And that's kind of our viewpoint. We think they will pivot and become a little more dovish with their interest rate increases.
So I guess to kind of summarize what Tracey and I have been talking about, we do think inflation is going to recede, but the headwinds we'll have is that inflation doesn't recede from the high levels, that the Federal Reserve will keep the pedal to the metal, which would probably be the worst thing from a recessionary standpoint if you believe that we're slowing and inflation's falling. Fiscal policy, which is the Federal Reserve, continues to tighten enough to end in recession, and that equity markets reprice for a recessionary environment, meaning they would go lower, maybe another 5 to 10%, because a typical downturn in a recession is about 30%, correct?
Right. If you look at past history, I talked about a bear market. Normal bear market pullbacks are 20, 25%. We're there. A bear market with a recession could be closer to 30% pullbacks.
Right.
So and that's a big question mark.
And that's our risk. But what we do want to remind people is that a long-term investment approach really does pay off. While we have these years where everything's negative, and you can see in this chart on a 1-year time, if you're 100% equity, your big drawdown was 39%. I think that was in 2008, actually. And then a 50-50 portfolio could be down as much as 15%, which is probably close to this year at this point. But if you're a long-term investor, you benefit from sticking to your allocation, staying invested in the markets, and knowing what the appropriate allocation is. And we stress that with every client, and as one of the foundations of our approach with our clients is figure out what your goals are, where you need to be, what risk level you can handle, and follow through with it. And we would be open to talk to anyone about this if they want an update. Talk to your relationship manager, call your portfolio manager. We'd be glad to entertain any additional questions. With that, I think we've ended our comments for today. And if you, Chris, I know we were kind of pushing time here, but are there any comments or questions in the chat box?
There have not been any submitted at this time.
Okay. Well, if anybody, we'll end it here, but if anyone has any questions, anything they want to discuss further, please let us know. Reach out to us. We are available to discuss whatever comes up in your mind. And thank you very much for attending. And we're hoping for a better second half of 2022. Thank you.